The market begins the year believing the Fed is done. None and done is the operative phrase, as in no hikes. And it's worth looking at this in two ways. First, what's the Fed expecting? And then gaming out what has to happen in the economy for the market to be right. That is, it sounds like a Robert Ludlum book or something like that. What is the zero hike scenario? Like some sound effects on that. Let's do a little history first. Pantheon points out, as Ian Shepardson says, markets now think the Fed is done. This time last year, markets thought the Fed would hike twice in 2018. Markets aren't always right. A little humility always helping out. So here's the Fed's own scenario first, okay? The consensus forecast among Fed members, 2.3% GDP growth, unemployment 3.5%, falling a little bit, inflation 2%. That's a two-hike scenario. I actually expect this to come down to be maybe more in the one area. Now, what does a zero hike scenario look like? Here's my guess. I want to tell you what I did here, guys. I sketched this out on pencil, and then I read about a dozen economic reports, and I pretty much stuck with what I have. So let's take a look, guys, at the wall here and take a look at what a zero hike scenario, one hike scenario, two hike looks like if they have it. There we go. Let's go to the left here. Your zero hike scenario, I'm expecting it would be GDP in the 0.5 point to 1.9, which is top end would be around potential growth. You'd have rising unemployment, and then you'd have inflation can still be at the Fed's target or falling. You can have your problems with this.
We have to have less than 2% GDP in order to get zero hikes?
I do. And
so that you mean that the consensus Fed forecast has to get down below 2%?
Exactly. Yeah. Exactly. It has to get down lower. So now let's go to the 1 to 2 hike scenario, which I acknowledge is a bit of a cop-out. I don't know if it's 1 or 2, but here's in the range there. And that's growth that's at or a little bit above potential. Steck is watching this closely, our camera guy. He's really interested in this. Unemployment stable or falling, and inflation 2% can be either stable or rising there. And then here's your 2 to 3 hike scenario. I think you're up near 3%. So, guys, if you could hear me in Englewood Cliffs, if you could do a wider shot and look at all of this now. Yeah, Becky, you have a question.
I have a question, Professor. You don't put anything on here about market reactions to anything. Is the Fed not going to be watching that? If the market throws a huge taper tantrum, whatever you want to call it, do any of these scenarios?
The market is one of
altered?
my big factors that could affect. You know, the market is like a hurricane in the sense that it is its own weather system. Right? You have a deep downdraft in the market. It creates economic outcomes. And Alan Greenspan, over the years that I've been covering him, has really changed his attitude about the market. The market from, classic Fed thinking used to be something that reflected the economy. Mm-hmm. More and more, Alan has shifted his thinking to the market being something that creates economic outcomes by itself.
Which gets me back to a conversation we had with Tom earlier this morning. Tom, you think there's a closer and tighter link to it, too.
I think financial markets now do lead the economy. Steve, like going back to your board, like what would be the scenario for a Fed to cut? Because
if you go to that thing, the last one, you notice a 0.5 point growth. Mm-hmm. Lower than that, I think you would get to a potential scenario of the Fed cutting and possibly easing back on its balance sheet, which is a whole separate discussion that we've had, I think, 8 times now, and perhaps devoted as much as 120 minutes of cable television time. I do want to share this commentary from Ellen Zentner from Morgan Stanley, who says, though a growth correction does not mean recession for the economy, financial markets march to a different drummer and may respond like they're in a recession. So that's something that could happen from that end. Look, you can all fill in your blanks here. Those are ideas for you. You have to be consistent, which is, I don't think you can. You don't have to be.
I was going to say
that's a good idea to be consistent. You can't sit here and expect, I think, strong numbers from the tax cuts, and then argue the Fed ought to stand pat. Those are incompatible, in my opinion. If you think the tax cuts are going to deliver 2.5% plus growth next year, you cannot dial in 0 for the Fed.
Unless you think the trade war negates
inflation?
The tax cuts.
Stop worrying about prosperity. It's inflation you should be worried about.
I am worried about it. I'm not worried about inflation,
Joe.
Prosperity. But people have used the semantic argument is a little weird. People say there's no inflation. That's not true. There's 2% inflation. There's inflation at target.
That's the Fed's guard.
And so when you think about how policy should respond, and I'm not saying it's the right way to go, this is the way they normally would do this, is they say, look, I got inflation at target, I got unemployment below target, and I got growth above target. I should at least be at neutral, and the Fed does not feel it's quite at neutral yet. Right. So I think there's 2 things. Be careful what you wish for is the first thing. I think you got to question your assumptions on the second.
Yeah, on the one hand, you have Powell saying, look, it's true, inflation hasn't responded very much to good growth,
Right.
low unemployment. On the other hand, inflation wasn't that much lower when the Fed funds rate was at 0.